Hello and welcome to our first revision session for A-level accounting. Today we're going to be looking at double entry bookkeeping. So we're going to have a recap of some of the terminology, the DEAD CLIC mnemonic, and also some of the transactions that you might come across. So a reminder about some of the terminology that we use when we're doing double entry bookkeeping. First one is purchases. So these are items that the business buys for resale, usually at a higher price. We've got goods, which is a generic term that can describe either sales or purchases. So goods can either be sales, we have goods sold to customers, or goods bought for resale, goods purchased from suppliers. Cash sales and purchases. This is an important distinction to make between cash sales and purchases and credit sales and purchases. So cash doesn't necessarily mean cash. It can be either cash, cheque or bank transfer. But these are transactions that are paid for at the time. So a cash sale, the customer pays you either by cash or by cheque or by bank transfer, possibly even credit card at the time the sale is made. Same applies with purchases. Those goods are paid for at the time, so no credit has been allowed. So with these transactions, the double entry is always going to be between the bank and cash account, and then either sales if it's sales or purchases if it's purchases. So those contrast with credit sales and purchases. These are where goods are paid for at a later date. So we can make credit sales to our customers. They're going to pay us at a later date. So in that case, no money's involved at the time of the transaction, but we still need to record the sale, if you remember. So we would be debiting the customer's account and crediting sales. Same applies with purchases. No cash has changed hands, so the double entry doesn't affect the bank or the cash account, but we still need to record it. So in that case, we'd be debiting purchases and crediting a supplier account. When the money does change hands, though, later on, so when the customer pays you, then you would debit the bank account and you would credit their customer account, their trade receivable account. Assets are things that are owned by the business or amounts that are owed to the business. So items owned by the business would include non-current assets, things like land and buildings, motor vehicles, inventory that hasn't been sold, or you've got amounts that are owed to the business. So that could be in terms of trade receivables or other amounts that are owed to the business. Liabilities are amounts owed by the business, so bank overdraft and loan are a couple of obvious examples there. Also trade payables, so amounts that are owed to suppliers, are liabilities. Capital is the amount invested by the owner of the business. If you remember, this can be increased by any profit that's been earned during the year and is reduced by any drawings. So drawings are those amounts that are taken by the owner. That could be either in cash or by cheque or bank transfer, or we could have goods taken for own use. So that's an adjustment that we do to the accounts. So just to recap the double entry DEAD CLIC mnemonic then, on the debit side we have drawings, we have expenses, which includes purchases, wages, motor expenses, expenses being day-to-day running costs of the business. We also include things like depreciation, the charge for the year, and an increase in the provision for doubtful debts. We've got assets, so we talked about assets a moment ago, and trade receivables, which is a kind of asset. They live under current assets on the statement of financial position, and those are amounts owed by customers to the business. Capital, as we said, is the amount invested by the owner. That's always going to be a credit balance. Liabilities, bank loans, overdraft, so on. Income is going to include sales, usually as the main source of income, so sales revenue, but might include other types of income like commission received, rent received, bank interest received. And then lastly, on the CLIC side, we've got payables, which are amounts owed to suppliers. So every time a transaction takes place within the account, two of these items are going to be affected. So the key to double entry bookkeeping is identifying the two sides of the transaction. So for example, if the owner pays some capital into the business, they put their own money into the business. If it's paid in through the bank account, we're going to increase the asset, so the asset there that is the bank account, by debiting it, and we're going to increase the capital account by crediting it. So debit the bank and credit the capital. If the owner then decided to withdraw some money, we would record that as drawings, okay, and then we would credit however that money was taken out. So if it was taken out through the bank, we'd be crediting the bank account. If it was taken in cash, we would credit the cash account. So the key to understanding double entry, obviously, is to memorise this mnemonic, but every step of the way, identify the two accounts that are involved. And we're going to look at some examples now. So the first one we've got here is that the business purchased some postage stamps, that's quite a tongue twister, and paid in cash. So we need to identify here the two accounts that are involved. So we can see here we've got postage stamps, that's one of the accounts. So we're going to have a postage expense account within our ledger, and we've paid for it in cash. So that's the other side of it. So if we think about postage, then that's an expense. So if we look at our DEAD CLIC, we need to debit postage expense account and then credit the cash account, which is an asset. The reason we're crediting it is that we've reduced the cash account by that amount. So debit the postage expense account and credit cash to reduce the asset. Okay, question 2. This time we've purchased goods for resale on credit from R. Smithers. So R. Smithers is going to be one of our trade payables. No cash has changed hands, so there's nothing to do with the bank or the cash account this time, but we do know that purchases are a type of expense. So if we've purchased goods, then purchases is involved. We go back to the DEAD CLIC, purchases is a type of expense, so we're going to be debiting purchases and crediting R. Smithers, which is a liability, trade payables. So debit purchases, which will be under cost of sales in our income statement, and credit the R. Smithers account, which will be one of our trade payables. So if you remember, we record all the transactions within the individual trade payables accounts and then add them all up to find one total to put on the statement of financial position at the end of the year. Number 3, excuse me, purchase some computer equipment for use in the business on credit from JB Computers Ltd. So we can't put this down as a trade payable because trade payables are only to do with purchases, but we do still need to record the liability. So we think about the debit side of the transaction. We've purchased an asset, we've purchased some computer equipment, which is a type of non-current asset. So we're going to need to debit that account, and we're going to be crediting a liability account that we're going to need to set up for JB Computers Ltd. So do not credit trade payables in this type of example, and do not debit purchases. Even though it says the word purchase there, it's not purchased purchases, it's purchased a computer or some computer equipment. So we need to record it as a non-current asset, not as purchases. Question 4, purchased shop fittings for display, paid by cheque. So again, although we've purchased something, it's not purchases. Remember that purchases are only goods for resale. So this time we've purchased some shop fittings that we're going to use for display in our shop. So and it's been paid for by the by cheque. So it's going to go through the bank account. So the debit side of this transaction is to debit the shop fittings. That's to record the asset. And to credit the bank account. And we know it's the bank account because it's been paid by cheque. So it can't be cash or any other account. Example 5, sold goods for cash. This is pretty straightforward. If you look at your DEAD CLIC, we know that cash is an asset. Cash can never be a liability. You can't be overdrawn with cash. So the lowest it can ever go is a balance of 0. So if we sell goods, if you look on the CLIC side of things, sales is a type of income. So we're going to be debiting cash to increase the asset and crediting sales to record the income. Example 6, sold goods. This time we've received a cheque, so very similar to the last example. We're going to be debiting the bank in this case because we've received a cheque. So if we receive a cheque, that has to be paid into the bank account and then still crediting the sales account, which is a type of income. So it doesn't matter how these sales are paid for, whether they're cash sales, bank cheque received, or whether they're a credit sale, it all goes into the same T account, just one account for sales. So this time we've sold goods on credit to F. Brooks, so no cash has changed hands at this stage. So we still need to record the fact that we've made a sale, so we're going to be crediting the sales account, but this time we're going to debit F. Brooks, which is going to be an account within our sales ledger. It's going to be a trade receivable. So debit F. Brooks, trade receivable, and credit sales. Example number 8, this time we've bought a delivery van, paying for it by cheque. So remember, if we pay for something by cheque, it needs to come out of the bank account. We need to record the asset. We've bought a delivery van, so the debit is going to be to motor vehicles, or van account if you like, and the credit is going to be to the bank account paid by cheque, so it's going to reduce the bank asset there. Question 9, we've returned some of the goods that were purchased on credit from R. Smithers. So when we purchased the goods, we debited purchases, credited R. Smithers. This time we're going to need to debit R. Smithers to reduce the amount we owe to them, and we're going to credit returns outwards, or purchase returns. So debit R. Smithers to reduce the trade payable balance, and credit purchase returns or returns outwards. Either of those terms is acceptable, and that's going to have the effect of reducing cost of sales. So this isn't really a source of income, it's just merely reducing an expense. It'll be reducing purchases and cost of sales. Question 10. Credit customer F. Brooks has returned faulty goods. So those goods have been returned to us, so sales returns or returns inwards is going to be involved, and we're going to need to reduce the amount that F. Brooks owes to us. So the way we're going to do that is to debit the sales returns or the returns inwards account. It reduces income. It's the opposite of sales. When we sold the goods to F. Brooks, we debited the F. Brooks account and credited sales. This time we're crediting the F. Brooks account, but we're debiting sales returns or returns inwards. And if you remember from the income statement, that amount is deducted from sales revenue. So it's not an expense as such, it's merely reducing the income. So one minus the other gives you your net turnover. So when you take the total sales revenue and deduct all of the returns, you get the net turnover figure. Number 11, we've paid R. Smithers, who was a credit supplier, by cheque. So remember, if we've got money going out of the bank account, we need to credit the bank account. Don't be tempted to put the debit side into purchases, because we already recorded those purchases when we bought them, which was a few questions ago. Now we're paying R. Smithers, so we're merely going to reduce the R. Smithers trade payable account, debit that, and then credit the bank account to reduce that asset. And we know again that it's the bank account because it's been paid by cheque. Number 12, we've banked a cheque for commission received. So if you remember, commission received is a type of income. And if we put money into the bank, which we'll have to here, we're going to increase the assets. So we need to debit the bank account and credit the commission received account, which is a type of income. Okay, number 13, the bank has deducted bank charges of £25. Well, bank charges are a type of expense. It's what the bank deducts from your account to cover the cost of running the account for you. So we're going to debit bank charges, which will be an expense on the income statement, and we're going to credit the bank account, which is an asset. We're going to reduce the asset by £25. Okay. Number 14 then, the bank has charged interest on an overdraft. So remember, an overdraft is where you've taken more money, it's gone below zero, so you've taken more money out than you've put in, and you've got a negative balance on your account. So if we're charged interest, we're going to debit the interest paid account on the income statement, that's an expense, and we're going to credit the bank account. And remember that the bank account, if it's overdrawn, will be a liability. It won't be included as an asset. Number 15, F. Brooks, who's our credit customer, settled their account directly into the bank account by bank transfer. So we've received a credit transfer from F. Brooks, who's our credit customer. So that means that the bank balance is going to be increased. So we need to debit the bank account to increase that asset, and we're going to credit F. Brooks, the trade receivable account. Don't be tempted to put this one into sales. We already recorded the sale when that was made, and I think we also dealt with some returns that F. Brooks had made. So now they've settled the balance of their account, we need to credit their account to reduce that down.